When people hear the phrase export blockade, their minds jump immediately to images of ships stopped at ports and metals vanishing overnight from global markets. That reaction is understandable, but it is also incomplete. What actually matters is not the drama of the headline, but the structural shift underneath it, because markets do not move on shock alone. They move on who controls access, who sets priority, and who absorbs risk when supply chains are no longer neutral. My name is Kenzo, and I run Frontier Analysis, where we track institutional liquidity flows using the same Federal Reserve data that professional traders monitor in real time. Over the past few weeks, two developments have converged in a way that forces a reassessment of how the silver market functions. China's move to place silver under export licensing was the first signal. Russia's decision to align its own silver trade policies with strategic export controls is the second. Together, these actions do not eliminate silver from the global market, but they reshape how much of it is freely available to the West at any given time. And that distinction is far more important than the word ban suggests. To understand why this matters, you have to step back from spot prices and look at the role China and Russia actually play in silver REST ecosystem. Neither country is just a miner selling raw material into an open market. China is a dominant refining hub and the backbone of global manufacturing for solar panels, electronics, and electrical infrastructure, all of which depend on silver as an input. Russia, while less visible in retail narratives, is a significant upstream producer with deep ties to non-Western trade networks. When both countries move toward export controls, even if those controls are framed as licensing or prioritization rather than outright prohibition, they are asserting that domestic and strategic use comes first. The rest of the world receives what is left when and if it is approved. That is a very different environment from the one most pricing models still assume. The phrase combined 68% of supply gone is emotionally powerful, but it needs to be interpreted carefully. It does not mean that nearly 70% of global silver production disappears overnight. What it means is that a large share of supply is no longer guaranteed to flow freely into Western markets under purely commercial terms. China and Russia together account for a substantial portion of mining, refining, and processing capacity. And more importantly, they sit at key choke points in the supply chain. When both impose controls, they introduce friction. Friction does not destroy supply, but it delays it, redirects it, and often raises its cost. In commodity markets, friction is usually enough to change behavior long before any absolute shortage appears. There is also a timing element that matters. These policy moves are not happening in isolation. They are occurring against a backdrop of already tight physical markets, rising premiums for immediate delivery, and industrial demand that is structurally difficult to reduce in the short term. Solar manufacturers do not simply swap silver out of their production lines because paperwork gets harder. Electronics producers do not halt output because a licensing regime adds weeks to delivery schedules. Instead, they adapt by securing supply earlier, paying higher premiums, or turning to inventories that were never intended to be a primary source. Each of those adaptations pulls stress forward in time. By the time prices reflect it, the underlying imbalance has often been building quietly for months. This is where the contrast between paper markets and physical reality becomes important. Futures markets are designed to provide liquidity and price discovery, not to guarantee physical access under all conditions. As long as contracts can be rolled, cash settled, or offset, the system functions smoothly. Export controls challenge that assumption indirectly. When physical silver becomes harder to source reliably, more participants have an incentive to lock in supply rather than price exposure. That distinction matters. A market where most players are content with cash settlement behaves very differently from one where delivery becomes strategically important. The alignment of China and Russia increases the probability that physical access, not just price direction, becomes the dominant concern for certain buyers. It is also worth addressing the idea that these moves are purely political posturing with limited real-world impact. History suggests otherwise. When China imposed controls on rare earth elements in the past, the immediate effect was confusion and volatility, but the longer-term effect was a restructuring of supply chains and a sustained premium for secure access. Russia's past responses to sanctions and trade restrictions have similarly emphasized control over strategic commodities as a tool of economic resilience. Silver may not have the same visibility as oil or gas, but its role in modern technology makes it strategically relevant in a way that is often underestimated. None of this guarantees a dramatic price spike on a specific date. Markets rarely move on schedules that align neatly with policy announcements. What these developments do guarantee is a higher baseline level of uncertainty and a greater sensitivity to incremental changes in demand and inventory. In such an environment, small disruptions can have outsized effects, not because supply vanishes, but because the margin for error shrinks. When access is constrained, buffers matter more, and when buffers are drawn down, the cost of replacing them rises quickly. The most important takeaway from Russia joining China is not that the world is running out of silver tomorrow. It is that the assumption of frictionless global trade in silver is becoming less valid. As more supply moves under discretionary control rather than open market flow, Western buyers must compete, not just on price, but on timing, relationships, and strategic importance. That competition tends to favor those who plan ahead and penalize those who assume markets will always clear smoothly. This is the quiet shift that headlines miss, and it is why focusing solely on spot price can be misleading in periods of policy-driven change. As this situation develops, the key questions are not about panic or prediction, but about process. How quickly do licensing regimes slow exports in practice? How do industrial users respond when lead times extend? How much inventory is actually available to absorb disruptions, and at what cost? These questions do not have simple answers, but they shape outcomes more reliably than slogans ever will. Understanding that framework is the first step toward making sense of what Russia and China have just signaled to the silver market, and why the effects are likely to unfold gradually rather than explosively. To evaluate how this alignment between China and Russia translates into real market impact, it helps to look at where silver actually comes from and how it moves before it ever reaches an end user. Most investors picture silver as a simple pipeline from mine to market, but in reality it travels through multiple stages that each introduce dependencies. Ore is extracted, concentrated, refined, fabricated, and then distributed, often across several borders. Control at any one of these stages can alter availability downstream even if total production numbers appear unchanged. China's role as a refining and manufacturing hub means that a significant volume of silver mined elsewhere still passes through Chinese facilities before reaching global markets. Russia's role as a producer, tied into alternative trade networks, adds another layer, because its output increasingly bypasses Western intermediaries altogether. When export controls are introduced at multiple points along this chain, the effect compounds. A licensing requirement does not simply slow exports from one country, it forces every participant downstream to reassess timing and risk. Refiners become more selective about whom they supply. Distributors hedge by increasing inventories. Industrial users front-load purchases to avoid future delays. Each of these actions is rational in isolation, but together they tighten the system. The result is not an immediate shortage, but a reduction in flexibility. Flexibility is what keeps markets stable. When it erodes, volatility rises even if headline supply remains adequate. This is why the combined influence of China and Russia matters more than their raw share of production. It is not just how much silver they control, but how central they are to the pathways silver takes. Western markets have grown accustomed to treating silver as globally fungible, assuming that metal can always be sourced from somewhere at a marginally higher price. Export controls challenge that assumption by introducing non-price barriers. Approval processes, geopolitical considerations, and strategic priorities all sit outside traditional supply and demand models. When those factors enter the picture, price becomes a lagging indicator rather than a leading one. Another layer that often goes unnoticed is the difference between visible and invisible inventories. Exchange-reported stocks and ETF holdings are transparent, but they are not the whole story. A large amount of silver sits in private vaults, industrial stockpiles, and semi-fabricated forms that are not easily mobilized. Export restrictions make these distinctions more important. Silver held in the wrong location or form cannot simply be redeployed without time and cost. As a result, markets may appear well supplied on paper, while participants on the ground experience delays and rising premiums. This divergence between perception and experience is where stress accumulates. Industrial demand further complicates the picture. Silver's use in photovoltaics, electronics, and electrical infrastructure has grown steadily, and much of that demand is inelastic in the short term. Manufacturers can optimize designs and reduce loadings over time, but they cannot eliminate silver without compromising performance. When access becomes uncertain, these users prioritize continuity of supply over price efficiency. They are willing to pay more, sign longer-term contracts, or accept less favorable terms to secure inputs. This behavior shifts bargaining power upstream and reinforces the impact of export controls, even if volumes remain technically available. It is also important to consider how alternative supply routes respond. In theory, higher prices and tighter conditions should incentivize new production and refining capacity outside China and Russia. In practice, this response is slow. Mining projects take years to develop, and refining capacity requires significant capital and regulatory approval. Scrap recycling can increase, but it is constrained by collection rates and economic thresholds. None of these adjustments happen on a quarterly timeline. That lag creates a window during which policy changes have disproportionate influence relative to their nominal scope. Financial markets, meanwhile, operate on much shorter feedback loops. Traders react to headlines, flows, and positioning, often without fully accounting for physical constraints. This can produce periods where prices move sideways or even decline despite tightening conditions, because futures markets reflect sentiment and liquidity more than logistics. Over time, however, persistent physical tightness tends to assert itself through higher premiums, backwardation, or increased delivery demand. These signals are subtle and easy to dismiss until they reach a tipping point, at which stage adjustments can be abrupt. The alignment of China and Russia also carries symbolic weight. It signals a broader trend toward resource nationalism and strategic control over materials deemed important to domestic priorities. Silver may not yet be treated with the same urgency as energy or food, but its role in technology and infrastructure places it on a similar trajectory. As more countries reassess the risks of relying on open markets for critical inputs, export controls become a tool of policy rather than an exception. Each use normalizes the practice, making future interventions easier and more likely. For Western participants, the challenge is not simply predicting price movements, but adapting to a market where access and reliability carry a premium. This requires a different mindset. Instead of assuming that markets will always clear efficiently, participants must account for delays, disruptions, and administrative hurdles as part of the cost structure. Those who fail to do so risk being caught unprepared when conditions tighten, even if they appear benign on the surface. At this stage, the most telling indicators are not dramatic price spikes, but changes in behavior. Are industrial buyers extending contracts? Are refiners reallocating output? Are premiums for immediate delivery rising relative to futures prices? These signals reveal how market participants perceive risk, and they often precede visible shifts in price. By the time headlines catch up, the underlying dynamics are usually well advanced. Understanding these mechanisms helps frame the significance of Russia joining China in controlling silver exports. It is not about a sudden collapse of supply, but about a gradual reordering of priorities and flows. Markets can function under these conditions, but they do so with less margin for error. That reduced margin is what ultimately shapes outcomes, rewarding those who anticipate change and penalizing those who assume continuity. As these supply-side shifts work their way through the system, the next question becomes how different market participants are likely to respond, because policy changes do not operate in a vacuum. They interact with incentives, constraints, and human behavior. One of the first responses typically comes from intermediaries rather than end users. Traders, distributors, and refiners sit closest to the friction points created by export controls, and they tend to react defensively. When access becomes less predictable, they increase buffers, and that means holding more inventory than usual, even if carrying costs rise. This behavior alone can tighten markets because metal that would otherwise circulate freely is pulled off the market and parked as insurance. This dynamic is often misunderstood. Observers see inventories rising in certain locations and assume that supply is plentiful. In reality, those inventories may represent precautionary hoarding rather than excess. The distinction matters. Excess inventory signals weak demand. Precautionary inventory signals perceived risk. Export controls from China and Russia increase perceived risk, not because silver is vanishing, but because timing and reliability are no longer guaranteed. When enough participants act on that perception simultaneously, the aggregate effect can resemble a shortage, even if total supply has not materially declined. Another response comes from industrial users who operate on just-in-time supply chains. These firms are acutely sensitive to delays because disruptions can halt production lines that cost far more per hour than the price of silver itself. Faced with uncertainty, they often shift from spot purchases to longer-term contracts, even at higher prices. This locks in supply, but reduces liquidity in the open market. Over time, more metal is spoken for before it ever reaches exchanges or dealers. This is one reason why spot prices can lag physical tightness. The competition for supply happens off-screen, through contracts and relationships rather than public bidding. Financial players respond differently. Hedge funds and speculators are primarily concerned with price direction and volatility, not physical access. They may view export controls as a bullish narrative, but they also weigh macro factors such as interest rates, currency movements, and risk appetite. This can lead to periods where speculative positioning moves against underlying fundamentals. For example, a strong dollar or tightening monetary policy can pressure silver prices even as physical conditions tighten. This divergence can persist longer than many expect, because futures markets can absorb sentiment-driven flows that have little to do with logistics. Over time, however, sustained physical tightness tends to influence financial markets through secondary channels. One such channel is the futures curve. When near-term supply becomes more valuable than future delivery, backwardation can emerge, signaling a premium for immediacy. Another channel is delivery behavior. As more participants choose to stand for delivery rather than roll contracts, pressure on exchange inventories increases. Exchanges can manage this through incentives and rule adjustments, but each intervention carries trade-offs that affect confidence and participation. None of these developments imply imminent failure, but they do reflect stress. The alignment of China and Russia also has implications for currency and settlement dynamics. As trade increasingly shifts toward non-Western partners, transactions may occur outside traditional dollar-based systems. While this does not eliminate the dollar's role in commodity pricing, it complicates settlement and increases transaction costs for some participants. Silver traded under these conditions may carry additional premiums related not to scarcity, but to payment risk and compliance. These factors rarely make headlines, yet they shape real-world pricing for large buyers. It is important to emphasize that none of this guarantees a single outcome. Markets are adaptive systems. Western producers may expand capacity, alternative refining hubs may develop, and technological substitution may accelerate at the margins. Policy decisions can also be reversed or softened if unintended consequences become politically costly. Export controls are tools, not immutable laws of nature. Their impact depends on how aggressively they are enforced and how long they remain in place. This uncertainty cuts both ways, creating upside potential and downside risk simultaneously. From an analytical perspective, the key is to move beyond binary thinking. The silver market is unlikely to flip from abundance to crisis overnight. More plausible is a range of intermediate states characterized by episodic tightness, elevated premiums, and increased sensitivity to disruptions. In such an environment, price movements may be sharp but uneven, driven by bursts of adjustment rather than a smooth trend. This challenges simplistic narratives that promise linear outcomes and easy timing. For investors and observers alike, the practical question becomes one of exposure and resilience. How much volatility can be tolerated? How important is physical access versus price exposure? How do tax, storage, and liquidity considerations shape net outcomes? These questions are personal and context dependent, which is why broad prescriptions are rarely helpful. What can be said with confidence is that policy-driven changes tend to reward preparation over reaction. Those who understand the structure of the market are better positioned to navigate periods of stress, regardless of whether prices move dramatically or not. It is also worth reflecting on the broader pattern at work. Silver is not unique in facing increased policy intervention. Energy, food, and critical minerals have all seen similar trends toward export controls and strategic stockpiling. These measures reflect a world that is less confident in the stability of global trade and more inclined toward self-sufficiency. In such a world, assumptions that held for decades may no longer apply. Markets still function, but they do so under different rules, and those rules favor foresight over complacency. As Russia joins China in asserting control over silver flows, the signal is clear, even if the outcome is uncertain. Strategic materials are increasingly viewed through a lens of national interest rather than pure market efficiency. That shift does not eliminate opportunity, but it changes its nature. Understanding that change requires patience and a willingness to look beyond headlines. It requires asking not just what happened, but how participants are likely to adapt, and where friction is most likely to appear. Ultimately, the story unfolding in the silver market is not about a dramatic disappearance of supply. It is about the erosion of assumptions that made supply feel effortless. When effort increases, so does cost, whether measured in price, time, or risk. How those costs are distributed will determine who benefits and who struggles in the months ahead. Recognizing that dynamic is essential to making sense of why policy alignment between China and Russia matters, and why its effects are likely to be felt unevenly rather than all at once. As this analysis comes together, the final step is to pull back from individual mechanisms and look at what they collectively imply for the silver market as a whole. When China and Russia both move toward tighter control over silver exports, the immediate temptation is to frame the situation as a binary event, either a collapse or a nothing burger. Reality rarely works that way. What actually emerges is a more complex landscape where access, reliability, and timing matter more than they did before. Markets do not need a dramatic shock to reprice risk. They only need enough friction to change behavior. That friction is now being introduced at multiple points simultaneously, and its effects are likely to be uneven, gradual, and occasionally abrupt. One of the most important implications is that silver begins to behave less like a purely financial asset and more like a strategic input. When materials are treated as strategic, participants evaluate them differently. Industrial users care less about marginal price differences and more about guaranteed delivery. Governments care less about maximizing export revenue and more about insulating domestic industries from external pressure. Investors who recognize this shift early tend to focus on structure rather than noise, because structure determines who absorbs volatility when conditions tighten. This is why policy moves matter even when they appear modest on paper. Another implication is that traditional signals become harder to interpret in isolation. A flat or declining spot price does not necessarily indicate abundant supply if premiums are rising. and lead times are extending. High reported inventories do not automatically mean excess if those inventories are held defensively or are inaccessible to certain buyers. In an environment shaped by export controls, surface-level data can be misleading. Context becomes essential. Understanding who holds inventory, where it is located, and under what conditions it can be mobilized matters as much as headline numbers. It is also worth considering how narratives form around these developments. Markets are social systems as much as mechanical ones. Stories spread faster than spreadsheets, and simple explanations often gain traction even when they obscure reality. Some narratives will exaggerate the impact of export controls, promising immediate scarcity and explosive price moves. Others will dismiss them entirely, pointing to historical resilience and adaptive capacity. Both extremes miss the point. The real impact lies in the middle, where incremental constraints accumulate and force adjustments that are easy to overlook until they become unavoidable. From a longer-term perspective, the alignment between China and Russia on silver exports fits into a broader pattern of fragmentation. Global trade is becoming less uniform, with parallel systems developing alongside traditional Western frameworks. This does not end globalization, but it reshapes it. Commodities move through more complex routes, subject to more conditions, and priced with more risk embedded. Silver, because of its dual role as an industrial input and a monetary metal, sits at an interesting intersection of these trends. It is affected by policy decisions in ways that are both subtle and consequential. For anyone trying to navigate this environment, the most valuable asset is not certainty, but flexibility. Markets shaped by policy risk-reward those who can adjust position size, time horizon, and expectations as conditions evolve. They punish those who anchor to a single outcome or rely on assumptions that no longer hold. This is not a call to action in the sense of urgency, but a reminder that analysis must evolve alongside reality. Static models struggle in dynamic systems, and silver is increasingly part of such a system. As this video comes to a close, it is worth reiterating that none of this analysis depends on hidden information or dramatic claims. All of the data and policy changes discussed here are publicly available, and their significance lies not in secrecy, but in interpretation. Understanding how export controls alter incentives, how markets respond to uncertainty, and how physical and financial layers interact provides a clearer picture than focusing on any single headline. The goal is not to predict an exact price or date, but to understand the forces at work so that surprises are fewer and decisions are better informed. If you want to explore these ideas further, this channel is dedicated to breaking down complex market dynamics in a way that emphasizes evidence, probability, and structure over hype. If this analysis helped clarify how policy decisions can ripple through commodity markets, consider liking the video and subscribing to Frontier Analysis. That support helps the channel continue producing in-depth research and long-form discussions like this one. Thanks for watching, and I will see you in the next analysis.